We're embarking today on our Bible study, The Truth About Personal Finance, what the Bible and historical academic research say is the best path to God-honoring financial independence. This will be the 8th lesson in a series of 19. Our guiding verses are, submit to God and be at peace with him. In this way, prosperity will come to you. Job 22:21. And faith is being sure of what you hope for and certain of what you do not see. Hebrews 11:1. Many, Lord, are asking, who will bring us prosperity? Let the light of your face shine on us. Psalm 4:6. This will be our guiding verse for this investing lesson. Deuteronomy 8:18 says, but remember the Lord your God, for it is he who gives you the ability to produce wealth. And Isaiah 52:15 says, for what they were not told, they will see, and what they have not heard, they will understand. God-pleasing personal finance and investing principles are foreign in today's world. Unfortunately, when it comes to investing, more people are led by the love of money rather than by Christian principles. It is the goal of this section to clarify sound principles of investing that, if adhered to over a lifetime, will allow the average investor long-term financial success, leading to financial independence and a secure retirement. We're going to look at the difference between saving, investing, speculating, and gambling. First, saving. Most of us think we are saving, we are investing. Yes, you need to become a good saver to have the resources to invest, but savings are typically placed in accounts that are liquid, meaning they can be easily accessed in a moment's notice. Savings are usually placed in a high-yield online bank savings accounts, money market mutual funds, or brick-and-mortar bank savings accounts. The bank savings and online high-yield savings accounts are FDIC insured up to $25,000 or $250,000 per account, while money market mutual funds are not insured. Why is saving not investing? The real returns of money market mutual funds and online high savings accounts will at best barely keep up with inflation. So saving can help keep your money from diluting in value, as it would if you placed it under a mattress or buried it in the dirt. But due to inflation, will probably never give you a real rate of return. In the parable of the talents, the master was not pleased with the man who did not use savings or invest the money he was responsible for, when in Matthew 25:18 it says, the man who had received one bag went off, dug a hole in the ground, and hid his master's money. When the master returned, he replied to the wicked and lazy servant in Matthew 25:27, you should have put my money on deposit with the bankers, so that when I returned, I would have received it back with interest. Saving. John Clements, in his book, The Little Book of Main Street Money, says, the benefits of saving is that it can give us peace of mind. Living within our means helps us feel financially content. Saving is a bargain compared to spending. Every dollar earned and spent is subject to taxes. Instead, stash that dollar in a 401k plan, and we get to keep the entire dollar, allowing it to grow tax deferred. It doesn't take huge sacrifices to become a top-notch saver. By increasing your savings by 5% and reducing your spending by 5%, you have achieved a 10% in savings. Finally, diligent savers need smaller retirement nest eggs. Why? Because they are accustomed to living at a lower standard of living. Investing. Investments are opportunities that have a greater likelihood of being profitable. Investing is taking your savings and buying real company stocks, which will pay in the form of dividends or increased value of the corporation, or lending to the government corporations in the form of bond purchases that will pay you back principal plus interest at a rate that will be in the long term exceed inflation. Real estate is another type of asset that has been shown to be favorable investment in the form of a REIT, real estate investment trust, mutual fund ownership, or if you like to be more hands-on, the ownership of rental properties with a positive cash flow. Investing for the average person should be in the form of owning stock, bond, or REIT index mutual funds for the long term. This avenue of investing provides the market return at a minimal cost with the immediate advantage of diversification, which of itself will decrease the risk of owning these assets. Investing is a way of putting your money to work for the long term, so that when it is needed in the future to fund your personal retirement or college savings, you will have gained a real return on your money greater than the inflation rate. The Bible says in Luke 19:13, "Put this money to work, invest," he said, "until I come back." In the parable of the talents, 2 of the men were responsible and invested the money, earning 100% return, as recorded in Matthew 25:16-17. The man who had received the 5 talents went at once and put his money to work, invested, and gained 5 more. So also the one with the 2 talents invested and gained 2 more. These verses not only emphasize the importance of investing, but also the urgency to start investing as soon as you are financially able. The time value of compound interest with longer time horizons is the reason for investing as soon as possible. Speculating. Speculation is an investment opportunity where the investment outcome is highly uncertain. Speculating is a form of trying to become wealthy in the short term by using methods that are more likely to fail than succeed. It can come in the form of day trading stocks, picking individual stocks to invest in without doing the appropriate research, or purchasing initial public offering stocks, or attempting to trade commodities, or purchasing cryptocurrency with no intrinsic asset value in the hope that somebody in the future will pay more for it, which is known as the greater fool theory of investing. Judges 19:24 says, "Don't do such an outrageous thing." Or the words of the angel in Numbers 22:32, "I have come to oppose you because your path is a reckless one." Or consider the words of Proverbs 23:4, "Do not wear yourself out to get rich. Do not trust your own cleverness." And finally, in 1 Timothy 6:20, it says, Turn away from godless chatter and the opposing ideas of what is falsely called knowledge. If you refuse to listen to me and speculate on any of the above forms of speculation, do yourself a favor. Do not commit more than 10% of your assets to any or all types of speculating behavior. Assuming a potential 100% loss for speculations might seem extreme, but this approach mentally prepares us for the catastrophe and helps us avoid allocating too much of our capital to speculations. Speculation, as a rule, requires us to be precisely right about the future. We only gain a profit with gold, art, or cryptocurrencies if investors are willing to pay more in the future for these non-income producing assets. This comes from the words of J. David Stein. Gambling. Gambling is an opportunity, and I use this term loosely, that has greater likelihood of losing money. Dr. Kingsley Jones describes a gamble as a bet of prospective negative return with reasonable statistic reliability. Jones further writes, customers who cannot reasonably expect a positive return should properly be sold on the entertainment to be had from losing money. In Lamentations 4:5, we read, those who once ate delicacies are destitute in the streets. Whatever the form of gambling, it is a way of chasing the fantasy of becoming rich without putting in the time or trusting God to provide for all of our needs. It is often another form of the sin of greed. Yes, let's set it straight. Gambling is a sin of the heart. In Jeremiah 8:10 we read, all are greedy for gain. And from Proverbs 28:19, those who work their land will have abundant food, but those who chase fantasies will have their fill of poverty. Don't delude yourself by thinking gambling is just entertainment or that it is your best chance of becoming financially independent. Your best chance of becoming financially independent is to take those gambling dollars and invest them. And by the time you are ready to retire, the true miracle of compound interest will take effect and multiply those dollars. As it says in 1 Timothy 4:7, have nothing to do with godless myths and old wives' tales. Rather, train yourself to be godly. Investing, risk versus reward. When it comes to investing, there's no free lunch. If you are investing in assets like stocks that have higher payouts, you are receiving those higher payouts as compensation for the additional risk you are taking. On the risk scale, from most risky to least risky, it goes like this. Small cap growth stocks, small cap value stocks, mid cap growth stocks, mid cap value stocks, large cap growth stocks, large cap value stocks, long-term treasury bonds, intermediate term corporate bonds, intermediate term treasury bonds, short-term corporate bonds, and finally short-term treasury bonds being the most safe. At each step of the risk scale, you should expect greater volatility with greater compensation for accepting that risk. Jack Bogle says, reward and risk do indeed go hand in hand, and you cannot enhance potential return without exposure to greater risk. Stocks. Buying stocks is buying a stake in a company or corporation with hope of receiving future value through company growth and dividend payouts. If you were to pick your own stocks for your personal portfolio, you would need to pick a minimum of 10 to 30 stocks among diverse segments of the stock market to be reasonably diversified. For the average investor, it would take a lot of hard work to research and implement the buying and selling of these individual stock selections. Instead, for the average investor like myself, I would recommend investing in stock index mutual funds for the foundation of your investment portfolio, for their instant diversification. You should not only invest in the U.S. stock market, but also in foreign or international stock markets. There are three primary components of a stock's return: the dividend yield, the share of profits paid to shareholders, the growth of dividends per share, how income stream grew over time. A company can only increase its dividend payments if its earnings are growing. A change in company valuation, an increase in the price to earnings ratio known as the PE, how much investors are willing to pay for a dollar's worth of earnings. Added together, these three components equals the annual return of stocks or a group of stocks. The dividend and earnings growth represent the math of stock investing, while the change in valuation reflects the emotion. The price of a stock today should equal the present value of future dividends. Stock investments risk can be high. We can undertake a market correction, which is considered a 10 to 20% decline in the market. Or if you hear the term bear market, the market has declined at greater than 20%. A realistic assumption for stock investments via an index mutual fund or ETF is a maximum drawdown of 60% with a recovery period of up to 4 years. I have personally experienced 2 bear markets in my investing lifetime where stocks declined over 50% while I maintained a 100% stock allocation. What to do in a market decline? Continue to buy stocks through dollar cost averaging all the way to the eventual market rebound. Do not sell on the way down or at the bottom out of fear. If the market decline was gut-wrenching for you, once the market rebounds, moderate your portfolio by buying bonds to better match your personal risk tolerance. International stocks. U.S. and foreign stocks fare well at different times, so holding both will give you a portfolio with lower overall volatility. Burton Malkiel says, when higher returns can be achieved with lower risk by adding international stocks, no investor should fail to take notice. Jason Zweig says, if you live in the United States, work in the United States, get paid in US dollars, you are already making a multi-layered bet on the US economy. To be prudent, you should put some of your investment portfolio elsewhere, simply because no one anywhere can ever know what the future will be at home or abroad. Jack Bogle says regarding international stocks, the rationale for investing in international funds is that they should provide an ancillary level of diversification to your portfolio. Since the prices of foreign stocks often move in different directions at different times and different dimensions than the prices of U.S. stocks, their inclusion in a diversified portfolio tends to reduce its short-term price volatility. With international investing comes currency risk. This currency risk means that a weakening U.S. dollar will enhance the return earned by U.S. investors in international markets, and a strong dollar would reduce their returns. I tend to agree with the late Jack Bogle when he recommends your exposure to mutual fund investing in foreign markets should not exceed 20% of your equity stock portfolio. Stock market recovery. An investor needs to realize when they take a loss in the stock market, it takes a larger gain to get back to even. Lose 10% and it takes 11% gain to get back to even. Lose 20% and it takes a 25% gain to get back to even. Lose 50% and it takes 100% gain to get back to even. Stock investing. Jesus says, "Thus the saying, one sows and another reaps is true. I sent you to reap what you did not work for. Others have done the hard work, and you have reaped the benefits of their labor." John 4:37 through 38. Now I realize that Jesus is speaking to the harvesting of souls, but it is just as easily could refer to the harvesting of earnings and dividends through corporate stock returns. In Proverbs 3:13 through 15, we read, "Blessed are those who find wisdom, those who gain understanding of how to successfully invest in stocks. For she is more profitable than silver and yields better returns than gold. She is more precious than rubies. Nothing you desire can compare with her." Bond investing. Bonds are a way individual investors can loan money to the U.S. Treasury or individual corporations with the expectation of receiving your principal in return with agreed upon interest payments over a specified period. U.S. Treasury bonds are considered the safest in the world as they are backed by the full faith of the U.S. government and as such are considered riskless. Corporate bonds, on the other hand, are rated based on their particular corporation's apparent ability to return your principal with interest without default. Corporate bond ratings. Investment-grade corporation bonds are rated between AAA to BBB with multiple gradations. AAA rating equals unquestionable credit quality. AA and single A ratings equals highly secured corporate or municipal bonds. BBB ratings equals the lowest investment grade rating. Any bond rated below BBB is considered a junk bond or what can be called a high yield bond. Jack Bogle says, "Since each drop in quality entails a commensurate increase in yield, gaining extra yield is relatively easy, but only by assuming higher credit risk." bond investing, interest rate risk. Interest rate risk simply means that changes in the level of interest rates are necessarily accompanied by commensurate changes in the value of your bond fund investments. Investors who ignore a bond portfolio average maturity do so at their peril. As J. David Stein says, the one thing investors in bonds must understand is as interest rates go up, the value of bonds held goes down, and vice versa. As interest rates go down, the value of bonds held goes up. If a bond is held to maturity, this point of price change becomes moot. Maturity is the term used to describe when a bond returns its principal outstanding and stops paying interest. Bond investing, interest rate risk. The higher, longer a bond's or bond fund's duration, the more its price will change as interest rates change. More specifically, a 1% increase or decrease in interest rates will cause an individual bond or bond fund / ETF to fall or rise in price by roughly the amount of its duration. In the case of bonds, their returns are primarily driven by prevailing interest rates at the time the investment is undertaken. The fundamental rule of thumb for investing in bonds and bond ETFs is that the best estimate of their future return for holding periods of 7 years or more is their current SEC yield. In comparing various bonds opportunities, you need to know the SEC yield or yield to maturity, the bond's duration, and the average bond credit quality. Bond funds expenses matter. Once again, the late Jack Bogle points out that the costs matter when he says, in every case and in every bond category, the superior bond funds could have been systematically identified based solely on their lower expense ratios. The lowest cost bond funds outpace the higher cost funds by between 1% and 2.2% annually. The average enhancement in return was 1.8% per year. Bond investing, Treasury inflation-protected securities. There is one bond sold by the U.S. Treasury known as Treasury inflation-protected securities, or TIPS, that are very useful in investment in times of inflation. The government resets the yield of these I-bonds every 6 months. You can purchase this bond online through the U.S. Treasury website for up to $10,000 per year. You must hold this 30-year bond for at least 1 year, and if sold in the first 5 years, forfeit the last 3 months of interest. I would recommend buying I-bonds direct from the U.S. Treasury rather than buying a TIPS mutual fund. Because when you use the mutual fund as your primary TIPS investment, there is a real possibility of losing the principal portion of your investment. While buying directly from the Treasury keeps your principal investment safe with this return upon sale. Cash. Cash or cash equivalents in the money is the money kept in your wallet, purse, checking, savings, or money market mutual funds. For the average investor, most cash is kept in checking for monthly expenditures or in online high-yield savings account or money market mutual fund accounts for emergency savings. For the wealthy investor, they may keep some cash on the sidelines for stock purchases when the market is falling and stocks are at bargain sale prices. Cash and cash equivalents are considered liquid funds. J. David Stein says, liquidity measures how quickly and easily you can sell an investment. What is the cost for doing so, and how long after you sell do you receive your money? Morgan Housel says, but if that cash emergency fund prevents you from having to sell your stock mutual funds during a bear down market, the actual return you earn on the cash is not 1% a year. It could be many multiples of that, because preventing one desperate, ill-timed stock mutual fund sale can do more for your lifetime returns than picking dozens of big-time winners. Real estate, or REITs. Real estate has been shown to be a worthy investment, especially when it results in positive cash flow through rental property. The properly purchased rental property should provide enough income in rent to cover the monthly mortgage payments, insurance, maintenance of the property, and provide cash flow to live off or invest in other assets. This should probably only be taken on by someone who has the skills to remodel, maintain, and manage such properties, or has the financial savvy or resources to thoroughly appraise the value, complete any necessary updates or changes to the property, and receive the necessary income from the rents to meet all the other financial obligations with cash flow generated from each month's rent. REITs are my preferred method of investing in real estate. I, like many, do not have the time or the skills to manage my own rental property. But through investing in a REIT index mutual fund, I can gain access to the dividends that are required to pay out from rental lease agreements they have under contract. REITs on the long term average a handsome payout of approximately 10% per year, rivaling the benefits of owning stocks. But with this average payout comes the risk of sequence of returns. REITs tend to be a quality investment during inflationary periods. Making sure to hold your REIT index fund in a tax advantage account, as the REIT sector is inappropriate for taxable accounts because most of the return comes from dividends, which are taxed at ordinary income. William Bernstein says, given the relatively high returns of REITs, they deserve serious considerations from every investor. Precious metals, gold and silver. If you are going to invest in them, I currently don't. Gold and silver are best held as an inflation hedge. As of June 2019, U.S. stocks had an average 10-year return of 12.21%, whereas gold had a return rate of only 3.71%. Gold will tend to rise in value as inflation kicks in, or in anticipation of a recession. From Proverbs 16:16 we read, "How much better to get wisdom than gold, to get insight rather than silver." From Proverbs 8:10, Choose my instruction instead of silver, knowledge rather than choice gold. If you choose to invest in gold or silver or other precious metals, keep your asset allocation to 5% or less of your portfolio. Cryptocurrency, Bitcoin, and others. Buying cryptocurrency with the hope of making a profit is nothing but pure speculation. The blockchain technology that it is based on does not create any value in and of itself. Its value is not based on earnings and dividends like stocks or interest payments from the government or corporations like bonds. J. David Stein points out that with a speculative asset such as cryptocurrency, there is no way to know if it will rebound or continue to plummet. There isn't a correct price because there's no income to determine if the price is too high or too low. Its value or profit is only found by selling it to someone else who is willing to pay more for it than you did, the greater fool theory of investing. Job 15:31 says, "Let him not deceive himself by trusting what is worthless, for he will get nothing in return." While Ecclesiastes 5:12 says, "The sleep of a laborer is sweet, whether they eat little or much. But as for the speculative rich, their abundance permits them no sleep." Speculative assets include collectibles, such as art or antiques, commodities, such as gold and oil futures, currencies, including the US dollar, and cryptocurrencies, such as Bitcoin. Commodities are hard assets, such as agricultural products, wheat or corn, metals, such as copper, gold, or silver, and energy sources, such as oil or natural gas. William Bernstein says, "The long-term return of precious metals and other hard assets, collectibles, precious stones, is trifling compared to their very high risk." Your investment focus. There is a laundry list of things outside of your control as an investor, to include things like inflation, the actions of the president, Congress, the Federal Reserve, the economy, tax policy, the actions of either political party, the level of interest rates, and so on. There's also a list of things you can control as an investor, and these are the areas you need to focus on, to include, in the words of Ben Carlson, how much you save, instituting a comprehensive investment plan, setting a reasonable asset allocation mix, defining your tolerance for risk, keeping your cost and training activity in check, taking advantage of tax-deferred retirement accounts, and making level-headed decisions. The investing miracle of compound interest. It is time in the market, not timing the market, that produces investing results through the miracle of compound interest. Job 8:7 says, "Your beginnings will seem humble, so prosperous will your future be." While Hebrews 11:1 says, "Faith is being sure of what we hope for and certain of what we do not see." The secret of getting rich slowly is the miracle of compound interest. Albert Einstein described compound interest as the greatest mathematic discovery of all time, and is credited with calling the miracle of compound interest the eighth wonder of the world. Jonathan Clements describes the miracle of compound interest like this: in each passing year, you potentially, if the market goes up, earn gains, not only on your original investment, but also on the gains you made in the previous years. Toss in some regular savings, dollar cost averaging, and the numbers become more impressive. If you continue to invest and persevere, over time you will reach a point of critical mass where your annual dollar investments gains begin to outgain the sum you put away in savings each year. Start saving or investing in your future first decade in the workforce so that you hit critical mass earlier in your career. The Rule of 72. The Rule of 72 is a convenient way to predict how many years before your investments will double. What you need to know in order to use this rule is the percentage of your portfolio return. Simply take the number 72 and divide it by the percentage of portfolio return. Example: if your portfolio is making 10% return, divide that into 72, and we find it will take 7.2 years for your portfolio to double. By looking at the results of the Rule of 72, you can also see how achieving higher investment returns will speed the rate of compounding interest. An example in a table, and this, I'm sorry, is hard to read, is if you have a 1% return, it takes 72% or 72 years to double your money. If you have a 2% return, 36 years to double your money. 3% return, 24 years. 4% return, 18 years. 5% return, 14.4 years. 6% return, 12 years. 7% return, 10.3 years. 8% return, 9 years. 10% return, 7.2 years. 11% return, 6.5 years. And 12% return, 6 years. 2 Corinthians 4:18 says, "So fix our eyes not on what is seen, but what is unseen." While Job 6:11 says, "What strength do I have that I should still have hope? What prospects that I should be patient?" The unseen prospects of compound interest multiplying your portfolio is the answer to Job 6:11. Proverbs 10:22 says, "The blessings of the Lord brings wealth without painful toil for it." Colossians 2:19 says, "It grows as God causes it to grow." And finally, in Mark 4:27, we read, "Night and day, whether he sleeps or gets up, the seed, investment money, sprouts and grows, though he does not know how." Just like a small acorn can grow into a mighty oak tree, so also the miracle of compound interest is able to grow our portfolios into a fully funded retirement plan. As it says in 1 Corinthians 15:37 through 38, when you sow, invest, you do not plant the body that will be, but just a seed. But God gives it a body as he has determined, and to each kind of seed he gives its own body. While Luke 19:21 reads, after years of investing, you take out what you did not put in and reap what you did not sow. This is all the work of God and the miracle of compound interest. As we read in 1 Corinthians 3:6, God has been making it grow. It's important to keep costs low. The expenses associated with operating a fund is the key driver of differences in fund performance. Fortunately, as individual investors, we are in an environment of decreasing fund expenses. Our investment returns will trail the stock market by an amount equal to our cost. This is a significant reason why active mutual fund managers so often fail to provide market equaling, or even more rare, market beating annual results or returns. Keeping costs low is why investing in a low-cost index mutual fund should be the basis of your portfolio. The late Jack Bogle, the originator of the index mutual fund, says, in the mutual fund field, therefore, costs assume tremendous importance for the long-term investor. Other things being equal, lower costs mean higher returns. Keeping costs low. Why is keeping costs low important for your portfolio? You keep what you don't pay in expenses. And studies have shown that you can gain an extra $100,000 or more in savings over your investing lifetime by keeping your costs low. Besides, when investing, there are not too many factors that you can control, but the cost you are paying to invest is clearly a factor you can control. And by intentionally choosing funds with the lowest expense ratios, that late Jack Bogle would always say, you get what you don't pay for. As it says in Job 34:22, teach me what I cannot see. The foundation of successful investing, low-cost index mutual funds. Instead of hiring a manager to actively select the stocks or bonds in your mutual fund portfolio, an index fund simply tracks a portion of the stock market or bond market. The most well-known index fund is probably the S&P 500 index, which tracks 500 of the largest stocks of the U.S. stock market. This is the fund recommended by Warren Buffett, the billionaire advisor of Berkshire Hathaway, as a destination for his fortune upon his passing, and would be an excellent selection for any investor, and especially as a first-time fund owner. For further diversification, another solid choice would be the U.S. Total Market Index Fund, which includes the stocks of the S&P 500 mid-cap, and small-cap stocks of around 3,000 to 4,000 U.S. companies. These two broad-based index funds give you instant diversification, a much smarter choice for the average investor than trying to pick a few individual stocks. These Vanguard funds have razor-thin expense ratios of 0.04%. Other fund families to consider are Fidelity or Schwab. J. David Stein says regarding index mutual funds, prudent investors focus on investment opportunities that have a positive expected return that aren't dependent on outsmarting other investors. That focus leaves many investors, including myself, to primarily use low-cost passive index mutual funds, or ETFs, in their portfolios. Burton Malkiel says, the index performance is not mediocre. It exceeds the results achieved by the typical active manager. And the results hold for big stocks and small, domestic as well as international. Moreover, the results are obtained if one looks at 10 or 20-year results, and it works for the bond market as well as the stock market. Index investing is smart investing. Charles Ellis says, in theory, active investment managers can try to succeed in trying to beat the market index with one or a combination of 4 investment approaches. These include market timing, selecting specific stocks or groups of stocks, making timely changes in portfolio structure or strategy, or developing and implementing a superior long-term investment concept or philosophy. If you are going to select an actively managed mutual fund for long-term success, you would hope the managers are using the 4 investment approach. Index mutual funds, words from Psalm 42, He set my feet on a rock and gave me a firm place to stand. And from Psalm 26:12, my feet stand on level ground. And from Psalm 27:11, teach me your way, Lord, lead me in your straight paths. That rock, level ground, and straight path in investing is low-cost, broad-based index mutual funds. If you are going to choose an actively managed mutual fund, you should make sure the outperformance is at least 2 to 3% higher than the comparable market index, as the increased trading in active funds results in 2 to 3% higher cost, and of course, even higher outperformance would be preferred. So be patient, long-term investors in a broad-based, low-cost index mutual fund. Proverbs 23:23, we read, buy the truth and do not sell it, wisdom, instruction, and insight as well. And from Ecclesiastes 4:6, better one handful with tranquility than 2 handfuls with toil and chasing after the wind. And from Deuteronomy 28:13, if you pay attention to the commands of the Lord your God that I gave you this day and carefully follow them, you will always be at the top and never at the bottom. The fact is that index mutual funds outperform 85% of actively managed mutual funds in any given year. And that percentage goes into the 90s as you look at 10, 20, and 30 and 40-year periods of time. The simplest way to invest is to invest in target date funds. The simplest way for any investor to invest without requiring you to do anything but automate your investment dollars into the fund is to invest in a target date fund. Simply put, this is investing your retirement dollars into a fund of funds with a glide path to decrease the aggressiveness of the asset allocation as you approach retirement. The target date fund automatically rebalances the portfolio for you. You just need to pick the fund date that most closely represents the date you intend to retire. An example would be a Vanguard target retirement date fund of 2060. If you use an investment brokerage such as Vanguard, you get the advantage of low-cost funds with razor-thin expense ratio of 0.08% and a minimum investment of $1,000. This particular asset allocation of each target date fund will be different depending on how close you are to your retirement date. The small cap and value premiums. Historical academic research has clearly shown that small cap stocks typically beat large cap stocks, and value stocks typically outperform growth stocks over the long term. If you were going to try to outperform the stock market index, I would choose to follow the academic research and invest in a small cap value mutual fund or ETF. If you choose to overweight your broad-based index mutual fund with a small cap value fund or ETF, I would recommend you only direct 25% or less of your portfolio in this area, and be prepared for long periods of poor performance where large cap and growth funds lead the market higher, as has been the case in the most recent past. If you do not have ironclad patience in trying to invest in the small cap and value premiums, may not be for you. In your case, you should be satisfied with receiving what is known as the market beta by investing in a total stock market index or a target date fund. Ben Felix of PLW Capital in Common Sense Investing says, value stocks by definition are the stocks with lower prices relative to their book value or earnings, while growth stocks have higher prices relative to their book value or earnings. There's nothing wrong with market cap weights, but there is evidence that certain types of stocks within the market should be expected to do better over time. Two of the most prolific examples are small cap and value stocks. In other words, small cap stocks were generating alpha, which is excess risk-adjusted return, and stocks with higher book value to the market price, commonly known as value stocks, had higher average returns that were not explained by market beta. Mutual funds versus ETFs. An individual investor, if we don't have any particular insight about whether a specific stock is priced correctly or not, we can instead own hundreds, if not thousands, of stocks via commingled investment vehicle such as an index fund or ETF. You don't have to try to find the needle in the haystack, just buy the haystack. These are words of the late Jack Bogle, founder of Vanguard. For most investors, they will be better served by investing in index mutual funds. The reason? It is too tempting to use ETFs for frequent trading. Burton Malkiel defines when best to use ETFs versus index mutual funds when he writes, ETFs are an excellent vehicle for the investment of lump sums that are to be allocated to index funds. ETFs require the payment of transaction costs. However, including brokerage fees, some discount brokers offer commission-free trading of ETFs and bid-ask spreads. No-load mutual funds will better serve investors who will be accumulating index shares over time in small amounts, as in dollar cost averaging. Tax advantage investment vehicles, 401k and 401b plans. You should always use a tax advantage investment account before a taxable account, unless the money is to be used in the next few years. Why? You save in taxes on each dollar invested exactly the amount of your tax bracket. These accounts are named for the area of the tax code that authorized their use. In the case of the 401k and 403b, these accounts are invested pre-tax, meaning the dollars invested are subtracted from your taxable income and invested prior to you receiving your paycheck. As such, the entire dollar is invested, but you will be required to pay taxes on that dollar and subsequent compound interest upon withdrawal, hopefully many years down the road. The government assigned contribution limits in 2024 for individuals is $23,000 per year, or $30,500 if you're age 50 or older. Traditional and Roth IRAs. These are tax advantage investments that work the same way as the 401k or the 403b, except the amount invested is limited to $7,000 if your age is under 50, and when 50 or older is given a $1,000 catch-up provision for a total allowable investment of $8,000 per year. Your best option if you have a long time horizon is best using the Roth IRA. Money for the Roth IRA is invested after tax. In this case, the dollar invested in theory is minus your current tax bracket. Obviously, we invest the full dollar amounts. The beauty of the Roth IRA is your money grows tax-free and is tax-free upon withdrawal, can pass to heirs without them owing taxes, and is not subject to required minimum distributions in retirement. Tax advantage vehicles, the 529 savings plan. For private school tuition or college savings, I recommend the use of the tax advantaged 529 savings plan. Each state has their own 529 savings plan, and you are not limited to using your own state plan. Go online at www.collegesavings.com to compare and evaluate different plans. We like using Utah's My29 plan as it uses low-cost Vanguard Index mutual funds. These funds are contributed after tax, grow tax-free, and are distributed tax-free as long as the funds are used for tuition, computers, books, or room and board. There is, however, tax penalties if used for something other than educational expenses. Congress just passed a law that will allow $30,000 of a 529 plan to be transferred out of the plan without penalty. If you think your student may not go to college or a technical school, you might instead opt to contribute to a Roth IRA, which also grows tax-free and is tax-free on distribution, but can be used for any purpose. Your 529 savings should be invested with a bent towards stocks, maybe 80 to 100% stock allocation, while gradually increasing the bond holdings from age 14 through 18 when your child will need the money for college. Jack Bogle writes, by age 18, the stock bond allocation should shift from 80-20 to 35-65. When college expenses come due, you can still sell stocks for tuition in the good stock years and sell bonds in the poor stock years. The best investment method, dollar cost averaging. Jonathan Clement says, dollar cost averaging is a disciplined, no-nonsense strategy of investing the same sum of money every paycheck, no matter how the market is performing. It helps us to overcome our reluctance to invest during market declines. Burton Malkiel says, it seems only logical that making many investments in the stock market at periodic intervals, known as dollar cost average, will provide greater stability of return than a single all-at-once commitment. The reason is that large single investments determines for once and for all the price at which you have committed your assets. Dollar cost averaging, the best investing method. Burton Malkiel continues, by investing the same number of dollars at regular intervals over time, regardless of the market's prevailing price level, you buy more shares when stock prices are low and fewer shares when stock prices are high, virtually ensuring a satisfactory average purchase price for your holdings. In addition, the regular reinvestment of dividends year after year, irrespective of the level of stock prices, contributes still further to the effectiveness of dollar cost averaging. Historical studies have indicated that investing a lump sum immediately was superior to dollar cost averaging the same sum, most probably due to time in the market. J. David Stein says, if the stock market trends down in the early months of the lump sum investment, then dollar cost averaging often trumps investing the lump sum all at once. The emotional benefit of dollar cost averaging often trumps the rational analysis that says investing the new funds in one lump sum is statistically the better performing option. As it says in Proverbs 13:11, whoever gathers money little by little makes it grow. Dollar cost averaging, the best investing method. The dollar cost averaging investment plan can be supercharged by making pre-tax payroll deductions into a workplace 401k or 403b plan. This automatically lowers your taxation for the year of the contributions. If you do not have access to a 401k, then work with your brokerage firm and set up a biweekly withdrawal from your checking account to get the automated hands-off supercharged effect into a Roth IRA. Lucille Tomlinson's comprehensive study of dollar cost averaging concluded, no one has yet discovered any other formula for investing which can be used with so much confidence and ultimate success, regardless of what happens to security prices, as dollar cost averaging. Tracking your investments. As a long-term investor, there's no need to track the market or the direction of your investments more than a couple times of the year. If you are using the above recommended investment program of automated dollar cost averaging investments into an S&P 500 or total stock market index mutual fund, you can sit back and relax and let this passive form of investing do the heavy lifting. Remember, it's time in the market, not timing the market, that will get you to your long-term goals. I recommend using what was formerly known as the New Retirement Planner, which is now known as Bolden Retirement Planner, calculator to evaluate once per year if you are on track to reach your long-term goals. As it says in Proverbs 19:11, a person's wisdom yields patience. And from Romans 15:5, may the God who gives endurance and encouragement give you the same attitude of mind. Never sell stocks during a crash. Remember, and this is very important, you never sell stocks on the way down in a crash, or especially at the bottom of a crash, no matter how severe, but stay fully invested without making any changes through dollar cost averaging. Why stay fully invested? Because as soon as you make the decision to sell, you then have to make a second decision of when to get back into the market. Research has shown that most market returns can be driven by just a few days of investing. If you miss those few days when the market starts to rebound, you have just locked in loss on your investment money. Secondly, you want to keep buying stocks during the decline, no matter how severe, as the decline is allowing you to buy stocks on sale. Time horizon. Your time horizon is the time in years from when you start investing for a goal until the time when you'll need the money. You must remember to consider your personal investment time horizon when you start the investing process. Hopefully, if you are using the wisdom I'm presenting as your guide, your time horizon for investing in stocks is somewhere between 5 and 50 plus years. Why is 5 years the bottom recommended for stock investing? Simply said, most stock market crashes recover between 1.5 and 4 investing years. Any goal for which you will need the money sooner would best be placed in a high-yield interest internet savings account or money market mutual fund, or maybe a short-term treasury bond fund. Investing patience. Your investing mindset is going to be one of patience. You are a long-term investor. If you do your job, which is to build your investment money up to at least 15% of your gross income, and start investing early, with your first full-time job in your 20s, you have an excellent chance to reach your long-term goals and become financially independent. Romans 8:24 through 25 says, "But hope that is seen is no hope at all. Who hopes for what they already have? But if we hope for what we do not have, we wait patiently." While Proverbs 14:29 says, "Whoever is patient has great understanding." And from Revelations 13:10, this calls for patient endurance and faithfulness on the part of God's people. Be careful of the investing advice you listen to and act on. We are bombarded by information today in the area of personal finance and investment strategies. Most of the strategies, investment advice, stock picks, and predictions of the direction of the stock market are to be ignored. You need to learn to screen out all the noise. In fact, most of the successful investors are contrarian, meaning they don't use herd mentality of what everyone else is thinking and doing, but move in the opposite direction of the crowd. As Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." As Ezekiel 28:4 says, "By your wisdom and understanding, you have gained wealth for yourself and amassed gold and silver in your treasuries." And from Proverbs 9:12, "If you are wise, your wisdom will reward you." Should I self-direct or use an investment advisor? Each person who invests will have to look deep into their constitution and decide if you have the interest, risk tolerance, and time to manage their own investments. Hopefully, by the time you finish this study, you will have a good idea of how to self-direct your own finances. You will increase your investment returns by self-directing, as you will not have to pay an advisor to manage your finances. There has been some recent research that has shown the average investor may benefit from using a fiduciary advisor, as they were able to add approximately 3% to client portfolio returns. I personally believe most of this added value comes from keeping clients from being their own worst financial enemy by panicking during market declines and selling their stocks at the bottom, thus locking in their investment loss. Financial independence on God. When I parenthesize the "in" in independence, I mean that we are dependent upon God. From Matthew 23:3, we read, "So you must be careful to do everything they tell you." And from 1 Chronicles 12:18, success to you and success to those who help you, for God will help you. Then we read from Deuteronomy 30:11, "Now what I am commanding you today is not too difficult for you or beyond your reach." And from Philippians 3:15, "All of us then who are mature should take such a view of things. And if on some point you think differently, that too God will make clear to you." Conclusion. Investing is putting money to work for the long term, so that when it is needed in the future, you will have gained a real return on your money greater than the inflation rate. When it comes to investing with increased rewards or returns, there is always increased risk, as higher investment returns are compensation for the additional risk you are taking. The primary assets of investing include stocks, bonds, REITs, and cash, mostly as held in an emergency fund. Stock investing is buying a stake in a company or corporation with the hope of receiving future value through company growth and dividend payouts. Bonds are a way individual investors can loan money to the U.S. Treasury or individual corporations with expectations of receiving your principal investment in return with agreed upon interest payments over a specified period. REITs, or real estate investment trusts, index mutual funds, allow the hands-off investor to gain access to the benefits of real estate by participating in the dividends gained through the fund, which are required to be paid out from the rental lease agreements they have under contract. Focus your investing energy on the things you can control. Having a comprehensive financial plan, your savings rate, your asset allocation, minimizing investment costs, understanding your risk tolerance, using tax advantage investment vehicles, and making level-headed decisions. The miracle of compound interest combined with time in the stock market produces investing results. Index mutual funds should be the foundation of every investment portfolio. A first-time fund owner should choose either the S&P 500 index or the U.S. Total Stock Market Index Fund as their initial investment choice for diversification and a low expense ratio. Target date mutual funds are the simplest way to invest and get instant diversification and age-appropriate asset allocation. ETFs are best for lump sum investments, while index mutual funds are best for investing small sums on a regular basis, as in dollar cost averaging. Action steps. Are you currently investing 15% of your salary in a tax advantage savings plan at work or in a Roth IRA? If not, contribute at least the minimum to get the company match in your 401k and add 1 to 2% each year as you receive raises from your employer. 2, are you using index funds and dollar cost averaging your investment dollars? If not, make index mutual funds the foundation of your investing and automate your investing through dollar cost averaging. Number 3, do you have a resilient and patient constitution and desire to take advantage of the small cap and value stock premium? Add a small cap value ETF of 10 to 25% to your current portfolio. 4, are you using your investment dollars on legitimate investments such as stocks, bonds, REITs? Or are you speculating in cryptocurrency or other speculative commodities? At least 90% of your investing dollars should be concentrated in legitimate investments with less than 10% in speculative assets. And I use the term assets loosely. Thank you, and God bless your investing.